or whether we think that the company is currently overvalued or undervalued. We currently think that this company is pretty undervalued currently.
7 highest return monthly dividend stocks to fill your pockets. Many investors are attracted to dividend stocks because they provide regular cash flows that are not dependent on rising markets. More importantly, there is a high probability that a company with a rich payment history will continue to pay dividends on a regular basis. This makes monthly dividend stocks particularly attractive. These income investments provide a distribution every 30 days rather than the more typical quarterly cycle. If you're looking for a stable source of income during retirement or regular cash flow to keep your savings going, then monthly stock dividends may be a good choice. Here are the 7 highest return monthly dividend stocks to fill your pockets. So, let's begin with the video. Before we get into details, it's also important to know a little bit about these dividend stocks' dividend companies. One useful metric for investors to evaluate the sustainability of a company's dividend payments is the dividend payout ratio. This ratio is total dividends divided by net income, and investors represent how much of the company's net income is returned to shareholders in the form of dividends and how much the company holds to invest in future growth. A ratio greater than 100% or negative net income indicates that the company has the potential to borrow to pay dividends. In both cases, the risk of a dividend being reduced is relatively high. 7. AGNC Investment Corp. Ticker AGNC. AGNC is a real estate investment trust, or REIT, which means it can avoid certain corporate tax burdens by returning 90% of taxable income to shareholders.
Currently, the earnings of the company have been doing quite well. Now, you might understand that this is actually the revenue of the company.
However, the company is not a property management company, but instead invests in residential mortgage pass-through securities and other mortgage-related investments that are guaranteed by companies funded by the U.S. government, such as Fannie Mae or Freddie Mac. Yes, but not completely risk-free. Government participation is an important support for these residential loans and helps to provide AGNC shareholders with a certain degree of certainty. Due to the strong real estate market and rising interest rates, the stock market has risen about 21% so far this year. But income-oriented investors should be more satisfied with the generous dividend of 12 pence a month. Current rate of return, 7.72%. 6. Pennant Park Floating Rate Capital, PFLT. Asset management company Pennant Park is primarily a lender to middle-market subprime companies, which means that companies with lower credit ratings must pay higher loan interest rates to offset the higher risk profile. PFLT first mitigates the risk to shareholders by conducting a detailed investigation before issuing any debt, and then by focusing on the first lien debt structure, which means you are the first of the creditors who want to be paid in a bankruptcy incident. The icing on the cake is that your variable rate loans actually see interest rate changes with the market. Given that interest rates have risen recently, this means that borrowers with such loans are now paying more PFLT than in 2020, despite its loan structure has not changed. Due to this interest rate trend, the stock price has risen by roughly 20% year to date. But Pennant Park's performance alone makes this monthly dividend payer worth watching, regardless of short-term stock trends. Current rate of return, 8.99%. 5. Prospect Capital Corp., PSEC. Prospect Capital is your monthly dividend share of investing in other companies and then transferring part of the proceeds to investors. Recently, according to Wall Street, the PSEC portfolio has shown great potential. In the past 12 months, the stock price has risen by about 60%, and the stock price has risen by about 85% from its 52-week low last summer. The real attraction for dividend investors is Prospect's revenue potential, which focuses primarily on private equity and private debt investments, with companies ranging from candle manufacturers and professional financial companies to IT and media service providers. Because these investments are rewarded in a diversified holding pool, Prospect enjoys a fairly stable income and stable monthly dividends and brings huge returns. Current rate of return, 8.23%. 4. Gladstone Investment Corporation, GAIN. Gladstone is a business development company, or BDC. Such listed companies are managed more like private equity funds or hedge funds than traditional businesses. They invest in other companies by holding equity and debt, and then share the success or struggle of those companies. Gladstone mainly focuses on acquisitions in the low-end market. In other words, these companies are small enough to be easily acquired with revenues of only $20 million to $100 million US, but they are not too small to be illusory. One of the most famous investments is Brunswick, a bowling products company with a large brand but a very professional business. By choosing such an investment, Gain can support a reliable monthly dividend, and due to its strong performance, the stock has risen 42% so far this year. For Gain, the debt-to-operating expense ratio is greater than reported by the 97.31% of U.S. stocks we are observing. The year-over-year growth of debt was 178.8%, and Gladstone Investment Corp's debt growth rate was about 94.29% for U.S. stocks. For 12 months of growth in earnings before interest and tax, Gladstone Investment Corporation is seeing a growth rate of 1,531.44%. This is higher than just 0.97% of U.S. stocks. Compared to the Central Financial Services stock price, Gain's price-earnings ratio is 12.5% lower and is currently 11.2. The Gain share earnings ratio has moved over the previous 194 months. Gain's price-sales ratio has changed for the past 194 months. Current performance, 5.83%. 3. Horizon Technology Finance Corp., HRZN. Horizon primarily provides funding for the technology industry, as you may have guessed from its name. However, you're not only investing in digital marketing or big data companies, as their current portfolio includes a wide range of pharmaceutical and healthcare technology companies. These include companies like Mustang Bio, a biotech company dedicated to the genetic modification of rare cancers. These pharmaceutical development companies can be extremely risky investments themselves, but Horizon's diversified approach helps provide stability. The company's generous 10-cent per share dividend proves it. 1 point, the dividend is paid every month like clockwork. Current rate of return, 7.18%. 2. Realty Income Corp. O. Perhaps the most famous monthly dividend stock, Realty Income, calls itself a monthly dividend company. This commercial real estate company owns approximately 6,600 properties, primarily occupied by major retailers, including Walgreens Boot Alliance, WBA, and Dollar General Corp., DG. In the last year or two, dividends have only increased slightly, but considering that pandemic-related disruptions have hit many commercial real estate companies, this is a good sign. At the time of writing, the company is very proud of its record of more than 600 consecutive monthly dividends, and investors can trust that it will continue to build on this historic foundation. Current rate of return, 3.99%. 1. SL Green Realty Corp., SLG. SL Green Realty is a REIT focused on commercial real estate in Manhattan. He currently owns approximately 84 buildings in one of the most desirable cities on the planet, covering approximately 38 million square feet. Although there were concerns last year that the pandemic would affect rents and occupancy rates, it turns out that SLG's stock price and dividend payments are flexible. By 2021, the stock has risen by 40%, and its monthly distribution has stabilized at a level of just over 30 cents per share. SL Green Realty, NYSE SLG shares have lost more than 1/3 of their value over the past year. The main factor that influences the stock price of office REITs, real estate investment trusts, is the impact of the spread of Corona-19 on the landlord's New York office market. The city suffered the most infectious disease. Current performance, 4.59%. A useful indicator for investors to measure the sustainability of a company's dividend payment is the dividend payment rate. This ratio is a measure of total dividends divided by net income. It tells investors how much of the company's net income is returned to shareholders in the form of dividends, and how much the company has retained investment in further growth. If the index exceeds 100% or is negative, meaning that net income is negative, it indicates that the company may be borrowing to pay dividends. In both cases, the risk of dividends being cut is relatively high. Let us know your thoughts in the comment box below. If you enjoyed this video, then don't forget to like it, subscribe to our channel, and hit the bell icon to stay up to date with our latest videos.